DIY investing or do it yourself investing makes a lot of sense to a lot of people. There are a lot of benefits of doing that. You may feel empowered. You are not dependent on any consultant or advisor to tell you what to do. You have control over your money and you take your own decisions. However, a lot of DIY investors end up doing some mistakes in that journey. In my experience, here are the top five mistakes that most DIY investors probably get into. Mistake number one, getting confused between activity and intelligence. What do I mean by that? Sometimes DIY investors, what they only need is a non dynamic and a patient portfolio that works for them over a long period of time. Things like index funds, things like two or three mutual funds, maybe two or three blue chip stocks, and that's it. It may probably do very well for them. But because a lot of DIY investors are not sure about their approach, and because of fear of missing out on a lot of things that they hear about in media, Instagram, WhatsApp, they end up over trading or over churning their portfolio. They end up getting into products that they should not be getting into. They do activities which they don't understand the risk of, and over a period of time, it can become disastrous for you and your wealth. Mistake number two, you end up chasing a lot of recent winners. What I mean by that is because the approach may not be scientific, because a lot of DIY investors will be doing it for the first time. They may essentially be only going by the previous few years or months, seeing which stocks or which mutual fund schemes have done well and choosing to invest in them. History and data both will tell you that a lot of past winners or a lot of portfolios that have done well in the past may not necessarily do well in the future. There is not a single stock or a sector or a portfolio or even a fund manager who can always generate the highest returns possible. There are cycles, there are forms, there are ups, there are downs. So, what should be an ideal portfolio at any given point in time is never a function of what worked in the last year or the last 5 years. And many DIY investors don't realize it before it is too late. Mistake number three that I've seen in my experience dealing with DIY investors, and this is the most important mistake that affects them over a long period of time, is because they are chasing few products or because they are chasing what has worked in the recent past, there is no asset allocation framework they follow. There is enough data and research to tell us that 80% of long term wealth is created due to a good asset allocation as compared to choosing a particular product or a particular fund manager. And because DIY investors sometimes do not have the asset allocation framework, it does affect their long term structural returns. The fourth mistake that a lot of DIY investors end up getting into is not having a framework of exiting or redeeming what is not working for them. We enter into a lot of schemes, we end up purchasing a lot of stocks, we end up researching what is probably good or not. However, because there is no framework to decide what should exit the portfolio, over a period of time, what you will realize is that there are multiple schemes and multiple stocks in the portfolio. Typically, over diversification leads to unoptimum returns also, which means you may have 25 schemes, 50, 60 stocks. You've accumulated it over a period of time because you read about it, because you researched about it, somebody told you about it. But you have not really created a framework of exiting. And as a result, you end up having an overpopulated portfolio. Exits have to be logical. If a stock is doing well, you don't exit that. If a stock is doing well, you chase, you add more and ensure that you're adding more allocation to that stock. Because if it's a multi-bagger, you want to ensure that more and more capital is invested in that multi-bagger over a period of time. However, most DIY investors, especially because they don't have the experience, they will periodically sell stocks that are doing well and use that money to average out on losing stocks. It's a cardinal mistake that destructs portfolio growth. You should, over a period of time, even if you start with 10, 15 stocks, over a period of time, ensure that you only have two or three stocks in the portfolio, which are your best performing ones. Chuck out the losers consistently. And that exit framework, that review framework is very important for a DIY investor. And the last mistake that I have seen a lot of DIY investors getting into is not acting rationally when things go bad. See, everybody is a good fund manager, everybody is a good stock picker, everybody is a good investor in a bull market. When Nifty and Sensex is rising, everybody seems to be a smart investor. What you do when the markets are not doing well will define your long term wealth creation journey. And a lot of DIY investors may not have the right guidance at that point in time. You see the market falling without realizing, you might get into panic selling. You might start selling portfolio because you're suddenly seeing losses that you have not seen before. And that probably is the time to actually accumulate stocks. So, guidance and advice in times when markets are not doing well, when there is a lot of volatility, how do you perform in those phases is the true test of a DIY investor. I really hope if you're managing your own money, which is not a bad thing at all, please ensure that you do not fall into these five pitfalls that I just spoke about.